Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, August 24, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And it was another inside day to the larger green candle from a couple of days ago. There was a lot of back and forth activity today, but all in all, the S&P 500 traded in about a 10-point range, $1 in the SPY. So it really was just a back and forth day. Not much happened, but there is still some conflicting information across the markets that we're going to go over. We went over some last night. We're going to do it again because what we're seeing here, when you have this kind of conflicting information and you have markets that go back and forth and it seems like they're relatively what I'll call is directionless, it's generally setting up for a larger move ahead. And I believe that to be the case. It could be in either direction, but I believe there's a larger move coming. Now, what's also interesting is next week is generally a very light volume week. You have the Labor Day holiday weekend coming the following weekend. That generally marks the ending of the summer doldrums. It's the end of the summer. And therefore, we can expect a pickup in activity following that weekend. So there are some traders, there are a lot of traders, investors, participants in the financial community that will be on vacation next week. However, that doesn't mean the market can't move. It doesn't mean it can't go down. It doesn't mean it can't go up. I'm just stating what generally happens. But what we do know is until and unless we close above the high from the 9th of August, this market has made a turn and its likely direction is downward. Again, they never make it easy. It's going to have large swings in both directions. We've already seen some of that take place since that top was put in, but we have a lot of overhead resistance. We're certainly going to see the market make an attempt to go higher. We're going to see the market make an attempt to go lower. One of these times, when it does make an attempt to go lower, it's not coming back anytime soon. I don't know exactly when that's going to be. Is it likely it's next week? It's not really likely it's next week, but it's certainly possible. The reason I say that is because, generally speaking, we get light volume next week, but anything can happen, so we can't rule anything out or we can't take anything off the table. On the upside, the sticking point is still going to be 246.60, which is the top of the breakdown candle that occurred on the 17th of this month. Now, last night I mentioned that Mario Draghi was speaking today. I thought it was today. I think I was wrong or incorrect in that statement. What's happening is both Mario Draghi from the ECB and Janet Yellen from our Federal Reserve here in the U.S., they're speaking tomorrow at Jackson Hole. They have the annual Jackson Hole, Wyoming event where all the bankers and whoever else gets together, and frankly, who knows what they talk about out there. But the reality is that they're both speaking tomorrow and certainly can move markets. Now, they usually have canned speeches, and they're usually not going to say anything, or at least try not to say anything that can spook the market, but you never know. It's not really what they say. It's how and what's interpreted from what they say. That's what's important. So it's the interpretation that the market may take from one of the two or both of what their speeches are, what they say, and what they're really trying to convey. That's what's important. But are we expecting anything drastic on a Friday? Yeah, typically not, but you never know. We'll see what happens. Now, here's the IWM, and the Russell 2000 had one of the conflicting stories today. So the Russell 2000 was up all day. It was certainly up higher than it finished. However, it was up about 0.33%, 51 cents. You know, it's not a great day by any stretch of the imagination, but when you have the SPDR that was down or the S&P 500 that was down, the cash index S&P was down 5 points, and the IWM or the Russell 2000 was up. Now, generally speaking, that's going to be a sign of upside in the market coming. More often than not, it's generally a sign that there's bullish behavior underneath the hood of the market per se. The IWM continues to work off some of the oversold condition that occurred. It's heading toward, almost got there today, heading toward the 200 period moving average, and potentially even above that. It will definitely run into overhead resistance at the top of this red candle, and watch where the top of this red candle comes in. It's going to come in coinciding with pretty much where the 20 period moving average is sloping down. So there's a lot of overhead resistance up in this area. If in fact the IWM did get up to that area, you would expect a reaction to the downside, if for nothing else than at least on an intraday or temporary basis. So the IWM was up today. We'll see if that's trying to tell us something. But here we have conflicting information once again, where the transports are melting away. Is this the ultimate canary in the coal mine? I believe so in the long run. This, and the IWM for that matter, have been telling us for a long time, long before the S&P 500 topped out, that there was trouble in this market, and you could see it more evident today where the transports were melting away, and now we've broken below the lows, and that is not necessarily good news for the transports, and in my opinion, not good news for the broader market. Now, that being said, you see another line that appeared on the chart. It's at basically 9,8999.19. That's an important level for a couple of reasons. So, number one is, and the reason I'm bringing this up is because it may be a simple, from a daily chart perspective, it may be a simple fake out of a breakdown, if you will. And what I want to show you is when you look over at the weekly chart, okay, and I'm not saying that this is the end or it's a fake breakdown and then we're just going to rally to new highs. I'm just saying that we may find some support in this area for an interim period of time. Look what you have. You have the 50 period moving average that came right up into where price is now. This also happens to be a 75% retrace when you look at this pivot low, okay, and this pivot high. So we're at a 7.5 retrace and the 50 period moving average right here at about 9,000. So I think that's probably going to prove at least an important level, at least for a period of time. If we cut through it, then we go right down to 88.50 and potentially even lower. But I think we may find a little bit of support here, which is pretty much right here, right now. It also happens to be 30 days from the pivot top to today. That's 30 trading days from your pivot top all the way through today. So it's interesting. 30 days is an important number. It's 30 days into a 50-week moving average, into a 7.5 retrace when you look at this pivot low down here to the pivot high. Okay, this is 75% retracement. Also the 50-week moving average. 30 days is generally an important number. So it's not going to be out of the ordinary for the transports to find some semblance of support right here, right now. No question, in the big scheme of things, the overall market is a little bit tricky right now, and that's common and normal market behavior for times like this when we've seen a character shift in the market, things get a little squirrely, things get more difficult from an analyst perspective because you have conflicting information. So what I'm trying to do is unpack as much data for you as possible so that you can see the bigger picture or the big picture from a bunch of different angles. And you can certainly see when I point all these things out why it's not so easy to just say the market's going to do X, Y, and Z, and here's the reason why. When the market changes character, what becomes more evident that it's the market's job to make as many people, whether they're traders, investors, professionals, amateurs, it doesn't matter. It's its job to make as many people look like fools as much of the time as possible. And that becomes more evident when we get into times like this when we've seen a shift in the markets. Moving over to the gold market, we're seeing some back and forth behavior. We've seen the tail candle from the top, which was a down day. Then we saw an up day, then a down day, then an up day, then a down day. So it's very difficult to read. In my eyes, it's making a bullish pattern, but we still have the tail candle top or the tail candle, which represents the top, and it wouldn't be out of the ordinary for gold to come down farther. It's just making a bullish pattern in an uptrend above all the moving averages. So again, conflicting information. Your tail candle says that gold wants to move lower. It did move lower off the tail candle, just not all that much. We never even came back to the 20-period moving average. And now essentially it's consolidating in this upper range, and it still is in an uptrend. So we've had an uptrend, we had a little pullback, another up move, a pullback, the tail candle, and now we pulled back and we're just going sideways. The question is, are we going to go down from the pullback like this, or are we going to go higher out of this bullish consolidation pattern? Not easy to call. For me, right here, right now, it's a no trade because I can make a case either way. And when I can make a case either way, I just assume stay away. We only want the high probability trades. They're not always going to work out 100% of the time, but if we don't have any semblance of a high probability trade, and this chart really isn't because of the tail candle and because of the bullish consolidation, if we don't have a high probability setup, we just have to essentially walk away and keep our money in our pocket. That's at least what I'm doing with the gold chart. Looking at silver, we came in today to test the 20-period moving average, bounced off of it. We still are making a bullish consolidation pattern underneath the 200-period moving average. We're sandwiched in between the 20, which is upsloping, and the 200-period moving average. So if this market's going to break higher, it's going to break higher probably sooner than later, but the longer we consolidate underneath this 200-period moving average, the more energy it's building for a move higher. As long as the 20-period moving average continues to slope upward and it holds price, then that's telling me that this market wants to make a move higher. At this point in time, 1780 has to be the upside objective or upside target if we did break higher. For a while, 1740 looked like it would hold the market. The longer we consolidate underneath the 200-period moving average like we are, the less I like the 1740 number. I'm going to have to go higher. 1780 is the number, represents this double top area up there. Looking at crude oil, not much to add today in crude oil either. We remain in the middle of the range, back and forth. Today was down, yesterday was up. You know, you can see what's going on here day after day. It's one day up, one day down, similar to the gold market that we just discussed. So when markets do this up and down, it's unclear. It's not necessarily making a very clear and decisive pattern one way or the other. So again, you have to stay away until things clear up, until and unless we can identify a pattern that tells us which direction has the high probability. Now that's the daily chart. Look what happens when you go over to the weekly chart of crude oil. This is making a bullish pattern on the weekly chart inside this green candle that has a low of 45.55. That's on a weekly chart, meaning that if we close below that level, this green up candle, if we close below 45.55, then crude's going down. But as long as each and every week holds above 45.55 and we continue to consolidate inside this green candle, that's the market's way of telling us that higher prices are coming. How high? Out of this pattern right here, I really couldn't see any more than the 50-period moving average that comes in at 51.43. That happens to coincide with a measured move or market symmetry, which you would have this green up candle, some consolidation, and then another up candle that would be similar to in size the first green up candle, and that happens to coincide with the 50-period moving average. So it makes sense. So if we were going to push higher, that's where the target would be. That's where the resistance point would be. You have to just call it 51 to 51.5. Bond market, same routine. Up, down, up, down, up, down. We're still riding the tide up the upsloping trend line that we've been looking at for far too long. I sound like a broken record. I'm sorry about that, but it just is what it is. We just continue to ride this trend line higher. There's nothing doing until and unless we break this trend line, but the market is creeping higher. While today was slightly down, the market's still creeping higher, and when you look over at the weekly chart, which gives us a better sense of what's going on, we still are in a bearish pattern from this down move here. Let me just draw it out real quick. You'll know what it's going to look like. So we have a down move, we have an up sloping, well, this is essentially a bearish wedge pattern, and this will generally promote another down move. However, if we get to the point where we close above the high of this red candle at 157.8, that's on a weekly chart basis, then we're free to move higher in the bond market. That hasn't happened. We're still holding this trend line, so nothing's really changed. I'm still looking for this trend line to reject the market at some point in time. Our dollar chart, not a lot of activity today in the dollar. A little bit of an up day after a down day. Again, just like the other markets, gold and the other markets, crude oil, the bond market, up, down, up, down, up, down. It's not clear. This is also indicative of what I said a while ago about the broader markets, about the total picture. When you have conflicting information and you have markets that are going up and down each and every day, that's telling you that the markets are readying for a more pronounced move. Whether that moves on the upside or the downside, we're not 100% sure, but this is certainly indicative of a market that's kind of tightening up. It's spooled up. It's like a tight spool of thread, tight spool of wire, where if you let go, it's going to unravel. And that's what's going to happen to this market. It's kind of wound up at this point in time. And it's not just the dollar I'm talking about. I'm talking about across the board. All the markets are kind of wound up right now, and they're going to make a move in one direction or the other. So I just want everybody to be on guard. We don't necessarily know whether it's going to be on the upside or the downside. Doesn't have to change the bigger picture, but remember, big swings in both directions come at a point in time like we're in now. And with that, I'm going to leave it there tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.